All right, thanks for sticking with me if you're still been listening to a lot of these videos. This is going to be a little bit different of a video. It's going to deal with trading strategies that I used last year when I started my account, and I used a number of different trading strategies. So there were I basically ran a multi-strategy convex portfolio designed to create asymmetric returns with a strong focus on systematically maintaining long volatility. My main strategy was ultimately a synthetic futures based strategy, but I also did, so I didn't do a lot of dispersion trading back into the market, which is just a fancy way to say that I was selling volatility back into the market. But I did do some call overriding, so there was some short vol trades in there. I did a lot of dispersion trading on the Dow Jones and components during the first quarter of 2018, and I also did a lot of stock replication during the first and second quarter of 2018. And then, as I said earlier, I did the synthetic future strategy, which was just a mean reversion strategy. And what a lot of these strategies ultimately produced, because they were long vol, they mimicked the performance that a CTA trend following strategy or hedge fund would have utilized. So when you ran the numbers, you had the positive skew associated with just being long volatility in the market and attempting to extract the difference between realized or difference between implied and realized volatility. So this particular strategy that I want to focus on and kind of highlight is a sophisticated dividend capture strategy. And I use this throughout the year. And part of the reason I'm highlighting this has to do with the fact that a lot of people are sitting on a lot of cash right now. Even though the market is steadily rallying, volatility realized is extremely low, and we're getting this slow churn up. But a lot of people don't want to put capital to risk or put capital at risk. So one of the strategies that you could use is a dividend capture strategy. So it's a low vol strategy because you're going to be shorting well, you're going to be selling dispersion back to the market, but you're also going to be long an equity position for a very short period of time. And the strategy is going to work on the one that I'm going to talk about today is going to be BP Prudhoe Bay Royalty Trust, which is ticker symbol BPT. It's and this, like I said, it's not going to be a basic dividend capture strategy. This is going to be more sophisticated strategy that you can put on. Where you're actually utilizing the option market to reduce your overall risk, and again, you're ultimately also engaging in yield searching or yield seeking behavior. So step one with this strategy is you're going to go out and you're going to purchase 2,500 shares, and dates are going to be vitally important to this strategy. So I'm just going to quickly get into how this works. So the declaration date will give you the information on when the company is going to actually do the ex-div date, the record date, and the payment date. Ex-dividend date is probably the most critically important date that you're going to have with the strategy. And I just want to preface this by going through the dates that actually happened during this past first quarter dividend that they paid out. So what you would have done is that on Tuesday, April 10th, 2019, you would have purchased 2,500 shares. And the reason that you'd have done that is because it's safer to you have a T+2 or a T+3 settlement, and you want to make sure that the broker has the shares in the account before it goes ex-dividend, which the ex-dividend date would have been 4/15. But you want to have those the settlement done by if you purchase on Tuesday 4/10, the settlement takes place on T+2 or T+3, so you have the shares in your brokerage by Thursday or Friday of that date. And it's credited to the account. The purchase price at that time on 4/10 would have been $22.53. So the cost of getting into this, and this is a hypothetical, assuming that you had, say $57,000 in cash sitting in your brokerage account, and you didn't want to put that into the market because you're worried about the current frothiness and the rapid rise and increase, and you just didn't want to be one of those individuals or investors that's attempting to do FOMO. So it would have cost you $56,000, $56,325 would have been the market value of the portfolio position on 4/10. Given the company gave the declaration information, which said that the quarterly dividend this time would be only 0.345 cents, which is substantially lower than previous dividends that they've paid out. Typically, what has attracted traders, hedge fund managers, and asset managers to this particular dividend capture payout on this particular stock had been the fact that the dividend had typically been a little bit over $1 and had given you probably almost a 3.5 to 4% yield on any given quarter, and then for the full year it was probably close to 12 to 15%. So the dividend income on those 2,500 shares, given the 0.345 cents, is going to be $862.50, which is only going to give you a yield of about 1.5%, which is good. I mean, if you think about it, it's very good, because a 1.5% yield over the course of 4 quarters is a little bit about 6% yield for the full year. And that's not too shabby. And this is again assuming that they're not going to be that they're going to keep reducing the dividend and it's going to stay stagnant. They came out a week before the declaration date and announced at the dividend, or at the declaration date on April 5th, announced that the dividend was going to be 34 cents as opposed to the typical 98 cents to $1.05 that they had previously paid out, which had to do more with the fact that there's some production issues with this particular security in terms of how they pay out. That's very well documented in the prospectus. I'm not going to go into it for this video because this is just focusing on the sophisticated dividend capture strategy. So the expected stock price, once you enter the stock, and the dividend yield is going to be 1.5%, and the dividend is going to pay out about 34 to 35 cents, you should expect a drop of 34 to 35 cents on the ex-dividend date. So on April 15th, 2019, you should expect the stock to drop by 1.5%. And then some people will say, hey, well, why is that possible? Why is that happening? Well, the main reason it happens is because there's an efficient market hypothesis that says that the market's just not going to give you a free dividend. So it's going to completely reduce your ability to engage in sort of that arbitrage opportunity from a risk-free standpoint. So the market drops the stock price by the exact amount of the dividend, so that you don't have people consistently rushing in there attempting to do that, and it just doesn't allow you to do that. So here's where the sophistication of this dividend capture strategy comes in. So the implied volatility on BPT is typically as low as 33, which would be about another way of saying that the stock moves 2%, or as high as 55, which is another way to say the stock can move as high as 3.4% on any given day. So I'm just doing an average of those two, the 33 low and the 55 over the course of the year, and just let's just say the stock on average moves about 2.76%. So first step is that you're purchasing the shares. You're doing it you're giving yourself T+2 or T+3 days for settlement. You're going to spend about $56,000 to get into the position. The next step is that you want to write a call, and you're going to be short a call. So when you write a call, you're also short a call. So those are similar language on that position. So what that means is that you're going to be collecting premium income on BPT. And what you're going to want to do is you're going to write 25 contracts, and you're going to use a call expiration date of 4/18/2019, which is the following Friday from when you purchased the position on Tuesday, 4/10/2019. And the price of those, the cost of those calls, when I looked at this trade to actually add this video here, was 70 cents. So on each of those 25 contracts, you will receive 70 cents, which means that you're going to collect premium of $1,750. I also want to point out that I'm not including any of the brokerage fees that you have to pay in this trade demonstration on how to correctly execute the sophisticated dividend capture strategy. So once you've written the call, you've collected the premium income. Step 3 is that is going to happen on the dividend date, on the ex-dividend date, which is going to be 4/15/2019, and this is critically important. So what you want to do on ex-dividend date is during the pre-market, you can go in and you want to sell the 2,500 shares that you purchased on 4/10. Let's just hypothetically say you sell those at a price of $21.85. So your old market value was $56,325. That was your purchase price market value, and now you're selling at $54,625, which gives you a negative net difference between the market value from your purchase to where you're going to sell of about $1,700. Now, here's the benefit of the sophisticated dividend capture strategy. Remember, part 2 was writing that call where you collect a premium of $1,750. Again, I'm not including any transaction costs that are associated with the contracts that you sold, but we're just hypothetically saying that it's going to net you $50. Smile face, happy. On 4/22/2019, which is the payment date, you're going to receive the dividend, and you're going to receive the dividend income of $862.50. Plus, you'll receive the $50 of the net of the premium that you collected versus the change in the market value. So in total, you'll receive 1.6% yield. So it's about $862.50, which is the dividend plus the $50, about $915. The benefit of utilizing a sophisticated dividend capture strategy is that you get to keep the full dividend. And again, it's if you're looking to increase yield without increasing risk, this is a great strategy to use. It's a low vol strategy ultimately, and I will preface and give a disclaimer here. When I first initially started doing the strategy last year, I attempted to do it in a number of different ways, where I bought premium on the put, or I bought the straddle on both the put and the call. And what I learned is that the best and most effective way to execute the strategy, and the most sophisticated and proper way to execute the strategy, is just to ultimately engage in a long equity position with a short call. So you're doing a short covered call, ultimately, is what it amounts to, where you're actually taking in the premium that's going to offset the drop in the equity price when it goes ex-dividend, and then you're able to usually fully collect. Sometimes it may be 95% of the dividend income, but sometimes in this case it was about 100% of the dividend income. And so on the call that you wrote that expires on 4/18, what could go wrong is the typical situation that could go wrong when you write a contract. The equity price could move against you for whatever reason. The market may sell off on 4/15 when everyone's selling out of the shares and reducing their exposure because they're on record to receive the dividend. But it could also go back up in value before the end of the week closes out, and you could be in a situation where your call, you have to actually buy the position back, and that's going to reduce the amount of dividend income that you have coming in. So it's a great strategy. It's one that I would recommend. Like I said, it's short vol, and it's good especially in this kind of market where you have commodity prices moving higher, and you also have realized volatility steadily moving lower. So in May, when the next dividend is going to be announced, you could probably engage in this and probably make a good, I guess, 1.5%, which is a great return to have at this point in time. If you look at the equity market and you think, okay, well, if this is going to produce 6%, a yield of 6%, you look at where the equity market currently is right now. Its equity yields are about 5.7%, and you look at 10-year treasuries, they're yielding only 2.57%. So it's one that's out there, sophisticated strategy. If you like it, there's going to be some more videos that I add. I'm going to go through the managed trade deal with China that's going to be announced in May, sort of kind of give you the scoop on how that actually works, talk a little bit about the current account deficit, talk about the trade deficit, also the fiscal deficit, give an explanation of how that has to be financed, why that's very important, especially to millennials, and give some detail on the mandatory spending stuff. So if you follow my Trader First Year stuff on stock tweets, you'll be pleasantly happy to hear the details on the next coming videos, and then I'll go over some of the economic data that's been coming out and sort of where I see the market going and how the forecasts are changing. So I appreciate you listening, and subscribe if you haven't subscribed. Thanks.